Great morning, fellow traders. This is Austin. It is Monday, May 15th. Not quite noon Eastern Time. Taking a look at the markets for today, and I've shut the charts off right about where I ended. And I'm going to do this on a daily basis this week for a few things, for educational purposes. And by the way, welcome back. I've been off the airwaves a couple of weeks. Markets are incredibly phenomenally dead, historically dead, as you know if you're watching them, and this is empirical data. I think, and it's in zerohedge.com and other places around the web. For example, the VIX has not been this low, has not spent this many consecutive days below the reading of 11 ever. So this is an all-time historical record for low VIX readings. The S&P has not traded in such consecutive narrow range days since 1962. In 1962, at this time, my sister hadn't even been born, and she's my older sister. She's 2 years older than me. She was born Halloween 1962. I was born the day after Christmas, barely after midnight in 1964. So the S&P has posted consecutive narrow range days for a longer period of time, not only prior to the advent of electronic markets, but prior to the advent of me. That's how dead the markets are. They've never been deader. And on any given day, there will be 1 or 0 trades in the past 3 weeks. And this all started, I should say it emphasized, and there's going to be an end to it. We're going to talk about the end to this because it's coming soon. But it started about 3 weeks ago when we had that 25 index point gap up overnight move in the S&P off French elections or some nonsense that shouldn't even matter to U.S. stock markets. What should matter to U.S. stock markets is earnings, corporate growth, buybacks, mergers and acquisitions, things like that, not who is going to be the next leader of France. I mean, that should not have a 25 index point impact on the S&P 500. Seriously, that's what the market manifestation is these days. What's the dollar going to do or not? What's the Fed going to do or not? What's central banks going to do? Are they going to blow up or aren't they? So in any event, this was today. This is a CM pattern marked here. This is key support. This is key resistance. This is key support. If this breaks down, then I'm looking to initiate a short somewhere in the 2388 area. And if this breaks up, I'm looking to initiate a long in the 2394 area. It could be give or take like 3 or 4 ticks either way. You know, the exact entry is not science, because if you try to pin an exact entry every single time, invariably you're going to get 1 tick to where it's just not going to fill. It's going to trade right to you, or it's going to trade 1 tick away, and it's going to take off, and you're not filled, and that's life. That's trading. There is no overcoming that whatsoever. All right, it's just the way it is. So, generally speaking, when one of these key support and resistance levels are broken, price will trade to it. Come on, give me the... And it will often pull back because the adage of prior resistance becomes support and prior support becomes resistance is older than all of us for a reason. That's how markets behave. This was a congestion area here. It broke. The tug of war was won by the long side, and then there was a retest, and then off it went. There are fundamental reasons for this. The fundamental reasons are there were a lot of buy stops here of shorts, and so some of the shorts got out, but some of them didn't. And the shorts who were looking to get back out for reasonable controlled losses did here, and then other people were buying. So there's an overwhelming number of buy orders here on this break because some people are buying to close for loss on their shorts, and some people are buying to open for hopefully win on their longs. Depending on whether this takes off or chops, it depends on sideways, depends on the results for everybody involved. But in everyone involved, the buy side from 2394 all the way to 2399 plus was the trade, and that worked with ease. Let me give you a bit of advice. If you ever read if you ever hear or if you ever think words similar to this. My bias today was, my outlook for the market direction was, I was leaning to the long or short side because. You hear anything like that where a trader says they had a preconceived expectation of what the market's going to do? That's a losing trader. That trader cannot win ever in the history of ever on a long-term basis. The only way you can prevail trading is to sit down and ask the market this. Okay, show me what you're going to do. Show me what you have in mind today. Show me what you're statistically more probable to do. And that's it. You have to sit and I have to sit in front of the charts with no bias whatsoever, as painful as that can be at times, and it takes a lot of traders years to learn, and some traders never learn that you cannot have a bias. You must let the market determine its own bias and then interpret that objectively and then trade that way. Even if you think that this gap up open here should close for whatever reason. What happened to my pointer? Even though, there's a gap up and, it's this and that and the other thing. Hey, it's telling you there's a buy. So the market's telling you long side only. The market is breaking key resistance per a CM pattern. All of the information is not on this chart, and it takes an educational program to explain why this is key resistance and not just a random spot on the chart. And it takes off and it works, and there you go. Yes, I was in this trade. Where did I get in? Doesn't matter. Where did I get out? Doesn't matter. Where would you get in? Where would you get out? And did you? If you did get in and out, then you understand the logic, and congratulations. If you did not participate in this trade, why not? The information is out there. It's available to you. It's that simple. Hope this helps. We'll continue the drama tomorrow, and as always, best trading wishes. Okay, great morning, fellow traders. Again, this is Austin. It is Tuesday, May 16th. You can see how yesterday played out after the, let's play out yesterday again. Okay, so they did the launch and they went right to the CM roadmap 233. This is 90% probable on any given day, and this is what we targeted. And after that, they just stuck there, a dead flat chop. And I think I said yesterday, pretty sure, that most days lately, with the VIX at all-time historical lows, with the S&P at all-time historical low-range dead moves since 1962, 55 years, record dead markets. There's often one trade, if any, and that was the one trade yesterday, and then after that, there's nothing, okay? Zero. And it's not going to be this way forever. These markets are coiling up. The last time the markets were similar dead to this, when they expanded, when the volatility finally broke out, it lasted for 2 or 3 years. And I would expect when the markets come unglued again, the volatility expansion is going to be measured in months or years. And we're going to be talking about a whole different thing. Then we're going to be talking about 15, 20 index point moves in the S&P per hour, and several of them per day, not, even in a week. So anyway, here we go today. How it resolved. There was the open range. Broke support, retested support. Support became resistance. Traded down to the CM233 roadmap, 90+% probable every given day, any given day, and then chopped sideways, absolutely nothing. There was just one trade the whole day. Two actually, through the sequence, one here and then one there. And then there was zero, nothing, nada. And that trade was signaled here when yet another CM pattern sequence was broken. It was broken once, slightly retested. Here's the second break. There is another adage in the markets that's older than all of us, and that goes, the second mouse gets the cheese. And what they mean there is usually the first break of anything or the first pullback is false, and there will be a second breakout or a second pullback. It'll be a double bottom, double top situation, or it will be a breakout pullback situation. In either event, this is not only for breakouts, it is for pullback traders too. The market commonly retests and retests to shake out weak hands. And this is where it shook out the weak hands, and then the real break came, and then they traded down. I was in this trade, and I was out of this trade. Where exactly doesn't matter. Were you in this trade? If you weren't, why not? The information's out there. It's easy to get. It's easy to learn how to do this stuff. And the time to learn how to do this stuff is now, while the markets are dead. The wrong time to learn, and when it's too late, when it's over with for you, is when volatility spikes. Trying to learn in high volatility markets is a nightmare. Prices flying all over, exploding all over. You don't even have time to think. You only have time to react. And if you don't know what to do now, you'll never know what to do then. Now is the time to learn. Hope this helps. See you tomorrow on Wednesday. Catch you then. Great afternoon, traders. This is Austin. It is Wednesday, May 17th. Lost track of time in this trilogy here. I was busy this morning or midday, and I'm busy this evening or later this afternoon, so I'm squeezing in our time lapse here for 3 of the 5 days. I'm probably going to, let's just make this one video, and then we'll do Thursday and Friday as a compilation, so it ain't 30 minutes long. In any event, after the dead flat chop for myriad hours yesterday, the markets are starting to unwind. And we talked about this. They're historically dead, historically low volatility, historically low range, dating back 55 years, and all that kind of stuff. Well, today they unwound a little bit, not much, but I mean it looks monumental because of what we haven't seen lately. What was this? 25-point move? 30 maybe? Not quite 30. 28 points or so on. Anyway, technically speaking, open range failed to go up, and anytime you have a failure one way, you usually have success the other. They failed to go up through the open range. They came back down, broke down, prior support, now resistance, traded to the 233. This is 90+% probable. Chopped around there. Traded to the 382. This is 62% probable. Likely to hit the 500 mark by the close, which is, no, not really. It's yeah, maybe. We got 8 minutes left. It's 3:52 or so. This is 50% probable any given day. 50%, 62% probable, 90+% probable. All markets, all symbols, all the time, no exceptions. In the trade today, well, there are several, obviously. The short side here, the short side here, the short side here. There were actually 3 sequences, maybe 4, that worked. But the first one was just before 10 o'clock. Once again, CM pattern broke the breakout, the obligatory pullback, the continuation. Remember what we said. Doesn't matter if it is a pullback or a breakout, especially in the S&P. It's usually retested. There's usually a second test, a double top, double bottom situation, or just a single pullback, and then a second wave, because it's the old adage, second mouse gets the cheese, and that's what happened. In this zone, anywhere here was the sell, and then wherever you covered, unless you're still short now, 10, 15, 20 points later, whatever the case may be. So that's how it's gone for 3 days. First 2 days, there was just one trade only. That was it. Today, there were at least 3 short sequences for a few points in the S&P. It remains to be seen what tomorrow and Friday do. That's what we have. Hope this helps. Catch you in the next segment. And as always, best trading wishes.